Welcome back, everyone. Today we're going to be shedding light on the problems appertaining to undergoing debt financing to raise funds for your business. So why should you desist, abstain, and refrain from undergoing debt financing to raise funds for your business? Well, unfortunately, lamentably, much to my dismay, much to my consternation, much to my agony, much to my grief, and much to my distress, the ramifications, the repercussions appertaining to undergoing debt financing to raise funds for your business can indeed be ineffably detrimental in all facets. They can be calamitous in nature. How so, you may ask? Well, first and foremost, to undergo debt financing, you may need to provide collateral up front. Undergoing debt financing can also lead to cash flow issues. It can cause your company or the more poised to become insolvent and subsequently defunct. When you undergo debt financing, you're not just responsible for paying back the principal amount of the debt, but you're also required to pay interest fees, which can be exorbitant. Furthermore, the interest fees can even possibly accrue into the principal each and every day, further amplifying the debt. When you undergo debt financing, you're also borrowing equity out of your business's future earnings. Your business needs to be profitable to not only service the debt, but to also be able to afford to pay interest fees on the debt, which can be substantial, to say the least. Furthermore, when you forgo equity financing and you opt to leverage debt financing in lieu of equity financing, you're also forgoing access to the expertise of venture capitalists who would normally have an equity stake in your business, in your company, if you undergone equity financing in lieu of debt financing. So you do not gain access to human capital when you undergo debt financing. Furthermore, even if you compete in niche markets, they are inundated with competition. They are deluged with competition. They are replete with competition. The competitors you compete against have ample competitive advantages. They have enormous customer bases. They have already attained robust brand equity, strong brand loyalty, and substantial brand recognition. So if you delude yourself into believing that you will be profitable in a very short period of time, then you may be disillusioned by the outcome, because the reality of the situation is that it can take years to become profitable. You're lucky if your business can break even and stay afloat amid its first few years of operations. On the other hand, if you're beholden to your creditors, you have to pay them back immediately. And if you cannot make your monthly loan payments, the ramifications can be direful. They can be calamitous. They can be adverse, to say the least. When you undergo debt financing, it can induce chronic stress, render you all the more prone to succumb to chronic fatigue and chronic burnout as you overwork yourself by making an earnest, valiant attempt to not only repay the principal amount of the debt, but also attempt to pay the interest fees that accrue on a daily basis. Debt financing can also adversely impact your credit rating, especially if you struggle to repay your debts. Discharging your debts is no easy feat. You have to be highly profitable to be able to afford to not only discharge the principal amount of your debts, but to also pay all the interest fees that accrue from being indebted to your creditors. When you undergo debt financing, and struggle to make the minimum payments on your initial loan, it can be arduous to obtain additional loans if you needed more loans to be able to keep your company afloat in the short haul so that it can be profitable in the long haul. Creditors want to see that your business is slated to become profitable in the imminent future. They want immediate payments, and if you struggle to generate short-term profits, then raising funds in the pending future, raising additional funds via debt financing can be a little more arduous, especially if you already have debt obligations that need to be fulfilled. On the other hand, if you're an equity investor and you relinquish an enormous equity stake, it can still be relatively easy to raise funds via relinquishing additional shares of equity to venture capitalists. On the other hand, if you're practically insurmountably indebted, almost insolvent, if you need additional loans to keep your business afloat, to sustain yourself, due to having a low credit rating and due to being able to due to being expected to struggle to be able to service a debt in the short haul, you're more than likely not going to qualify to receive additional loans. So it's not a potent, efficacious, viable, long-term strategy for raising more funds for your business, especially if you're struggling to make the monthly payments on your initial business loan. Nothing salubrious can ensue from undergoing debt financing. It can cause your credit rating to precipitously plunge into the abyss. It can render it more arduous for you to qualify for future business loans. It can cause you to forego having access to the expertise of angel investors and venture capitalists and human capital. It can cause cash flow issues. It can lead to bottlenecks, and it can be highly expensive to not only pay back the principal amount of the debt or of the loan, but to also pay interest fees on the principal amount. Furthermore, if your loans go into forbearance and the debt more rapidly amplifies to an unprecedented height, which will further undermine your company's future profitability, because not only does the principal amount need to be repaid, but those interest fees need to be repaid. When you undergo debt financing, your company has more liabilities than assets. When your company has negative net income, it's a little more poised to become defunct, and servicing the debt can require your company to generate profits immediately, which can be extraordinarily arduous to achieve, especially when you're competing in overly saturated, hyper-competitive markets that are replete with competitors who have enormous market share and who have a copious amount of potent competitive advantages that you cannot compete on par against. Startup companies cannot compete on par against behemoth brands. They have limited cash inflows. They have finite marketing budgets, and their competitive advantages are negligible relative to those of behemoth brands. Behemoth brands have lucrative customer bases. They have robust brand equity, strong brand loyalty, substantial brand recognition, and of course a host of product offerings in tandem with a slew of desirable service offerings. So resorting to debt financing should be a last resort, and doing so can be problematic because it can render your company all the more poised to become insolvent and defunct in a short period of time. Especially since you have to pay exorbitant interest fees in tandem with the principal amount of the debt. So just bear that in mind. And the bottom line, in sum, to recapitulate, you should do everything in your purview to preempt succumbing to leveraging debt financing. It's the utmost worst possible financing option for raising funds for your business. If you undergo debt financing, then it can render your business in arrears, metaphorically speaking, if your business is struggling to break even and cannot viably service the debt in the long haul. It's expensive to keep a company afloat, and you're better off selling shares of equity or resorting to crowdfunding to raise funds for your business in lieu of undergoing debt financing. If you undergo debt financing, you have to provide collateral to competitors. You can succumb to cash flow issues. You have to pay back interest payments in addition to the principal amount of the debt. And it can be arduous to qualify for future loans, especially if it causes your credit rating to precipitously plunge into the abyss as a result of struggling to be able to service the debt. Moreover, you're also foregoing expertise to venture capitalists, angel investors, and other highly knowledgeable, highly competent, and highly adept individuals when you undergo debt financing in lieu of undergoing equity financing to raise funds for your business. When you undergo equity financing to raise funds for your business, then your shareholders, your partners, your venture capitalists, your angel investors are apt to contribute to helping your company to grow. They want your company to thrive, prosper, and flourish. They want your company to grow its brand growth. They want your company to attain strong brand loyalty. They want your company to cultivate substantial brand recognition. They want your company to attain robust brand equity. They want your company to increase its sales volume, sales revenue, and profitability. They want your company to minimize its inefficiencies and maximize its efficiencies so they can contribute their knowledge, their expertise. They can provide guidance, wisdom. They can even consult you on how to improve your business operations. On the other hand, when you undergo debt financing, you forgo having access to their expertise because they're not a part of your business. You do not want to be beholden to creditors. And you want a team of ambitious, industrious, entrepreneurial, intelligent, competent, knowledgeable, wise, adept, shrewd individuals to harmoniously work together to render your business lucrative and profitable in a short period of time. And it's much easier to do that when you have a team behind you that is a backbone of your profitability and your profound success. When you try to do everything all alone, as entrepreneurs do when they often resort to debt financing, they become a little more poised to falter. When people have equity stakes in a business, they are inclined, they are enticed, they are incentivized to render that business profitable because it can redound to their advantage. Creditors, on the other hand, would prefer if your business is profitable, but they're also more concerned with being repaid the principal amount in tandem with interest fees, even if it causes you to lose collateral, even if it results in your company becoming defunct. They're more concerned about getting repaid than they are about keeping your business afloat in the long haul. I hope that you found this video to be insightful and enthralling. Have a blissful day. Goodbye.